What are the chances we see a bear market this year? What are the early warning signs? There's actually 5 of them. I'm going to share them with you, compare it to what we're going through right now. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so we've seen some volatility to start this year in the stock market. We've sort of been expecting that with the smooth ride that we had really in 2021, but ever since also the pandemic drop. But with valuations and other things and the Fed changing their tune, we've expected volatility. We've certainly had it thus far this year. What are the chances this leads to a bear market? Well, a bear market, drop of 20% or more, typically coincides with a recession. Not always. You can look at this chart in most recent time periods. Typically it lines up in the recession with a recession. Not always. We've had a few that were just barely not quite to 20%. They weren't lined up with a recession. So that's typical, and they typically happen about every 4 years or so. As a long-term investor, these are not something to be afraid of or something you've got to avoid in order to be a successful investor. But you do want to make sure that you're taking the right level of risk. You want to have the right expectations. You want to be aware of the likelihood of this upcoming based on some transitions in your financial life. If you're facing a big transition coming up soon, knowing or being able to anticipate, well, we might be seeing a bear market soon, might help you. So what are the signs? Are there any? Yeah, there's five warning signs that we could be seeing a bear market soon. Let's talk through those right now and then compare that to what we're going through today. So number one, I could have started and finished this video with, bear markets typically are connected to policy, a change in policy, and it's not as simple as that. But the number one sort of warning sign is tight money of the Federal Reserve, basically saying, we got to tamp things down a little bit. We've got to slow things down. Things are getting too hot. They're getting too speculative. There's too much froth. We've got to tighten things up. And so if the Federal Reserve shifts their tune and starts raising interest rates aggressively or shrinking their balance sheet or doing some other things to try and to tighten their monetary policy, that is an early warning sign of a bear market. Guys, I'm just going to tell you right now, obviously, that's created this volatility right now. Is the Fed finally saying, oh, wait a second, this inflation is here. This is more than what we expected, and it seems a little stubborn, and so therefore we've got to change our policy and start tightening things in order to manage inflation. Unfortunately, that's the number one, that's the first sign that we could be seeing a bear market coming up. The second early warning sign of an upcoming bear market is high inflation. And I mean, enough said, I'll just put that here. You guys know we are seeing the highest inflation that we've seen in 40 years, right? And so we know that's an issue. The inflation being 7% last year, it's hard to imagine it's going to stay 7% or even higher like we had in the 80s, where we had several years, or late 70s, early 80s, where we had several years in a row of this astronomical and growing inflation. Very unlikely. Technology is deflationary. There's a lot of deflationary forces out there, but it's likely inflation could be a little more stubborn because of wage and prices and those sorts of things. So I just did a video on that. But yes, we do have high inflation, rising inflation. That's the second warning sign of an upcoming bear market. The third is rapid economic growth. If you look back, a bear market typically follows a big boom that we've had, okay? And yeah, GDP, you wouldn't say it's record breaking, but it's the highest GDP that we've had in several decades, right? And certainly if you compare it to history, we've had unusually mild GDP for a few decades, for the past couple, okay? 1-2%. And if you go back to September of 2020, the Fed actually said, you know what, we need to create economic growth. We need to create inflation. We've got to get out of this 2% GDP range. That's not going to help us recover from this pandemic. Well, you got it. We did. We've seen the highest GDP, was it 5.7%, highest that we've seen in a long time. Take a look at these headlines. It could be a warning sign, and usually is. The fourth early warning sign of an upcoming bear market goes hand in hand with the very first one, and that is rising interest rates. Again, this is sort of a vehicle that the Fed uses to tighten their monetary policy and a way to slow things down. Interest, just like taxes, in my opinion, is sort of like a speed bump. It's a governor on growth, okay? And so rising interest rates too quickly, in and of itself, that's not a, and lots of people are thinking this right now, it's not a surefire, the stock market can't do well. Done lots of videos on that. The evidence is very clear. Stocks do well when interest rates are rising. They do better when interest rates are falling, but still, both environments, great times to be investors. This is just another one of those early warning signs to compare with the others. And yes, we've seen rising rates. The Fed has said they're going to raise rates. We'll see. We'll see how much that can happen because long-term growth is still expected to be muted. And we've done some videos on this about the yield curve inverting. So if long-term interest rates are staying here, but short-term interest rates start going up, that's that rising interest rates that I'm talking about here as a bear market indicator. As the yield curve flattens or even gets inverted, that's happened, that's preceded every recession over the past several decades. And then the fifth early warning sign to a bear market is overvaluation. Overvaluation. And it's always justified. There's always reasons to say, yeah, of course, things are a little bit overvalued right now, or valuation should be at this level. Of course there are. The circumstances are there. But when you compare valuation back to history, you can just objectively cut through the noise and the reasons, maybe logical, why, and you can see, well, are we overvalued or undervalued or fairly valued? And you guys know, we've been floating at the second highest price to earnings valuation ever on record, second only to the tech bubble. We've got the highest price to sales, which I think is potentially more important, more threatening right now because profit margins have ballooned and have been such a big deal that profit margins going up makes that PE ratio seem better, right? But it certainly justifies higher stock prices. I get it. But highest price to sales record and ratio, and then the highest level of the stock market compared to the economy ever, right? We're at the highest level ever. So there's no way of cutting it. It's justified. I can see all the reasons, but markets are still overvalued, right? And we've come down. That's come down thanks to the volatility in January, but you would still argue overvalued today. So guys, if those are the 5 early warning signs to a bear market, how are we doing today? Yeah, number 1, check. 2, yep. 3, check. 4, yeah, we're there. And 5, yeah, we've been there and been, kind of ringing the bell of warning with overvaluation. Guys, doesn't bode well. Now, the thing that I would tell you does bode well, so that you don't freak out or panic or think, well, geez, this is just a pessimistic video. This guy's expecting a bear market. No, I actually think it's unlikely we'll see a recession, and therefore hard to imagine, even if we do see enough volatility that we do dip down 20%, hard to imagine that it's going to last very long, okay? So instead of saying, well, the evidence objectively supports we could see a bear market, I would instead say we could see more volatility. The volatility we saw in January, scary, right? We could see more of that the rest of the year. I think that's possible, and we should be watchful for signs of a recession out there in the future. Unlikely though this year. So what's this mean? Number 1, make sure you're taking the right level of risk for your overall financial situation. This is not a time to be speculative or overly aggressive. You might get lucky, but right now with lots of volatility, I would make sure that you're taking the right level of risk for your overall financial plan, okay? Second, I'd make sure you've got the right strategies in place. Take a look, make sure that you're using the right diversified approach, the right momentum approach, maybe hedged approach as well. So work with your CFP on that. 3, prepare for upcoming transitions, right? If you've got a transition coming up, hey, I've got kids going to college in 2 years, I'm hoping to retire in 3 years, something like that. Make sure you've got a plan for that. Bear markets typically do happen every 4 years or so. They tend to drop on average about 30%, even though that bear market's a 20% threshold, and they typically last about 9-10 months. Recovery is about 18-24 months, something like that. So if you've got a transition coming up in that time period, you're going to want to make sure you're planful. That doesn't mean, well, if you've got a transition, get out. No, absolutely not. That's the wrong approach. Work with your CFP on that. And then finally, if we're going to see volatility in the market, we've already seen it, make sure that you don't have volatility in your personal finances. Make sure your blocking and tackling is taken care of. You've got the right margin in your financial life, that you are working your budget, that you've got a 3-bank account system, that you've got you're not taking on too much debt, you've got a fully funded emergency fund. Make sure that you've calm things down in your overall financial life so that as we see volatility, you're happy to continue to buy in at those buying opportunities because the rest of your financial life is stable. Work with your CFP on all of that. That's their job. They're going to help you with each of those things. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.